the pulse of the nation, understanding key economic indicators. Welcome back to Money Talks, your guide to the Canadian. My name is Rita, and I will be your host for today's episode of Canadian Securities. In our last episode, we explored the bustling Canadian investment marketplace, meeting the key players who make it all happen. Today, we shift our focus to something even broader, something that influences every single transaction and investment decision: the economy. Think of the economy as the heartbeat of a nation. Just like a doctor monitors a patient's pulse, blood pressure, and temperature to assess their health, economists and investors closely watch various economic indicators to gauge the health and direction of the economy. These indicators provide crucial insights into where we've been, where we are, and where we might be headed. Understanding them is vital for anyone navigating the financial markets. Inflation, the silent eroder of purchasing power. One of the most talked about economic indicators, and for good reason, is inflation. Simply put, inflation is the rate at which the general level of prices for goods and services is rising, and consequently, the purchasing power of currency is falling. If a basket of groceries cost $100 last year and costs $103 this year, that's a 3% inflation rate. While a little inflation is considered healthy for an economy, too much can be problematic. In Canada, the primary measure of inflation is the Consumer Price Index, CPI. The CPI measures the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. The Bank of Canada closely monitors CPI inflation, particularly its year-over-year percentage change, to inform its monetary policy decisions. For example, in the second quarter of 2025, Canada's CPI inflation was reported at 1.7%. This figure, along with historical data like 3.7% in 2023 Q3 or 1.9% in 2024 Q4, helps the bank assess inflationary pressures and adjust interest rates accordingly. Why does inflation matter to investors? Imagine you have $1,000 invested. If inflation is 5% and your investment only earns 3%, your purchasing power has actually decreased. Inflation erodes the real return on your investments, making it a critical factor in financial planning and investment strategy. The output gap, measuring economic slack. Another important indicator, often less discussed outside of economic circles but crucial for policymakers, is the output gap. This concept helps us understand whether an economy is operating at its full potential or if there's slack or overheating. The output gap is the difference between an economy's actual output, real GDP, and its potential output, the maximum output it can produce without generating inflationary pressures. Positive output gap. When actual output is above potential output, it suggests the economy is overheating, leading to inflationary pressures. Negative output gap. When actual output is below potential output, it indicates there's slack in the economy, meaning resources, like labor and capital, are underutilized. This can lead to disinflationary pressures or even deflation. The Bank of Canada, along with Statistics Canada, closely monitors the output gap. While not a single, easily quantifiable number, it's assessed using a range of indicators and regional data. For investors, understanding the output gap can provide clues about the future direction of inflation and interest rates. A persistent negative output gap might signal a period of low inflation and potentially lower interest rates, while a positive output gap could indicate the opposite. Interest rates, the cost of money. Interest rates are arguably one of the most impactful economic indicators for financial markets. They represent the cost of borrowing money or the return on saving money. The Bank of Canada plays a pivotal role in setting the benchmark interest rate, known as the target for the overnight rate. This rate influences all other interest rates in the economy, from mortgage rates to business loans. How do interest rates affect financial markets? Taxer. Bonds. When interest rates rise, newly issued bonds offer higher yields, making existing bonds with lower yields less attractive. This typically causes the prices of existing bonds to fall. Conversely, when interest rates fall, existing bond prices tend to rise. Stocks. Higher interest rates can increase borrowing costs for companies, potentially reducing their profits and making their stock less attractive. They can also make fixed income investments more appealing relative to stocks. Lower interest rates, on the other hand, can stimulate economic activity and make stocks more appealing. Real estate. Rising interest rates increase mortgage costs, which can cool down the housing market. Lower rates can make homeownership more affordable, boosting demand. Canadian example. Consider a scenario where the Bank of Canada raises its target for the overnight rate. This typically leads to an increase in the prime lending rate at commercial banks, which in turn affects variable rate mortgages and lines of credit. Homeowners with variable rate mortgages would see their payments increase, potentially reducing their disposable income and impacting consumer spending. This ripple effect demonstrates the profound influence of interest rates on the Canadian economy and financial markets. Employment data, a snapshot of the labor market. Employment statistics, such as the unemployment rate and job creation figures, provide a crucial snapshot of the health of the labor market and, by extension, the overall economy. A strong labor market, characterized by low unemployment and robust job growth, indicates that businesses are expanding, consumer confidence is high, and spending is likely to increase. This can lead to higher corporate earnings and a more vibrant stock market. Canadian example, Statistics Canada regularly releases the Labor Force Survey, providing detailed insights into employment trends. If the report shows a significant increase in full-time employment and a drop in the unemployment rate, it's generally seen as a positive sign for the Canadian economy. This could lead to increased consumer spending, which accounts for a large portion of Canada's GDP, and potentially higher inflation, influencing the Bank of Canada's monetary policy decisions. To conclude, in today's episode, we've delved into the fascinating world of economic indicators, understanding how inflation, the output gap, interest rates, and employment data act as vital signs for the Canadian economy. These aren't just abstract numbers. They are powerful forces that shape our financial lives, influencing everything from the cost of our daily groceries to the returns on our investments. By keeping an eye on these indicators, investors can gain a deeper understanding of the economic landscape and make more informed decisions. In our next episode, we'll explore the Canadian regulatory environment, uncovering the rules and bodies that ensure fairness and stability in our financial markets. Join us next time on Money Talks, your guide to the Canadian Securities Course.